Welcome to the weekly video update where I'll go over the action in the market for the week of May 12th through the 16th, and we'll see how things look for the week of May 19th through the 23rd. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. It was a pretty solid week. My goodness, we were up over 5.25% with the S&P 500. Even the small caps got into the action. Now, it's looking more and more like we won't know this for sure until we get some hindsight, unfortunately. But it looks like, at least for right now, the lows that were set in early April appear to be the lows for right now. We gyrated around. There was all these variables out there about the trade wars, what's going to happen with the tariffs. We still have a lot of unanswered questions and a lot of variables out there. But for right now, the market seems to like what's coming out with the trade wars and the tariffs. We saw a nice gap higher on Monday, and we were able to hold on to those gains. Now, we're also looking overbought in the short term and even intermediate term on the daily side. So, okay, before I get into the video, please know that I do videos every day. They are available on YouTube and Rumble. If you want to have access to them when they're immediately available, I do have a program. I'm setting up a YouTube membership program that will give you access to the videos right when they're available. If you're a YouTube member or a member of the full program that I have, you get those right away. I withhold them, the daily videos, until the close for the next day. And these videos are really designed to be viewed before the week starts, before the day starts. And so I think you would get more out of that. But if that's something that would interest you, please feel free to check that out. I also have a daily and weekly newsletter. And as you saw in some of the other videos that I'm splicing in here, it's $8 a month, and it's free for right now. Really, I'm just trying to get some initial interest at this point. But if you're interested in that, please leave a comment below or send me an email. I provide an email at the end of this video. Also, with every video that I upload, there's a PDF that you can download and look at the slides as well as the charts. Here is a link to the SPX investing program. If you want to find out more about that, you can email me. We can set up a time to talk on Zoom. I guess Skype is not really an option anymore. I also use Messenger or whatever video type software you might use, or just have an audio conversation. That's also possible. And then these are becoming a lot more clear as to how important they are. I've used them for decades, but they're called pivot points. And especially the 10-minute intraday pivot points can be very accurate because all the algorithms for the machines that trade automatically on the exchanges, they have all this programmed into them. And we hit one of those pivot points when we're going up and it says sell, sell, sell. We hit one of those when we're going down. We hit a support pivot point and it says buy, buy, buy. And you'd be amazed at just how accurate these things can be. Even if we blow through them, it just gives us more of an idea. Are we more positive? Are we more negative? I update those every day. There's a daily chart, and those pivot points last for the whole month. I don't use that one as much. The one that I really rely on is the intraday version based on a 10-minute chart. That's the one that I really focus in on, and I do update that particular chart every day on the YouTube community tab, and it's just freely available. You know ahead of time what the support and resistance levels are for that particular day. Also, I do have a private Facebook group, not really active, not a lot of members. If you want to join and maybe change that, that's another way to have access to me if you have any questions or feedback that you would like to give. And then I really go through and watch the YouTube and Rumble comments. The Binance comments, they get deleted. That's spam. That's a bot out there doing something. If it's a rude comment or just totally irrelevant to what we're talking about, those comments go away. If you want to have a legitimate discussion back and forth, feel free. either on YouTube or on Rumble. And on Rumble, mainly I get the social media experts that are really nothing but scammers that are out there just trying to sell you something that either doesn't exist or is very poor quality. And I do post both on YouTube and Rumble. Okay, so for the week, we were up 5.27%. That's a pretty big weekly move. And we've really been improving. And we were really stuck in this ping pong match. It was almost like a basketball going up and down because there were so many variables out there. We didn't know, okay, are we going to go up? Are we going to go down? But we did hit a very important support level right near the beginning of April. And we bounced up off of that and we've been gyrating around and we've been coming up from that level. And we're still looking negative when you look at a lot of our trends, but we're really seeing some improvement. And I'll go through some of that there. Now, what's been interesting is the last number of days, when I look at the daily charts, we're below average with the S&P. But when I look at the weekly chart, it says that we're above average. And I use a moving average to determine that. And it's just kind of strange how that works. And we are getting better with our technicals. And I'll go through some of the charts there. We're a little bit concerned about interest rates right now. We're getting close. In fact, we went above the 4.5% level on the 10-year yield, and that kind of spooked stocks a little bit there. But then we were able to come back down. That seems to be the go-to point right now for when stocks kind of notice what's happening in the bond market. And they're like, okay, we're above 4.5%. Instead of buying, I'm going to sell. Well, we'll see if there's more follow through to that. And inflation for right now, anyway, based on all the reports that have been coming out, doesn't really seem to be a problem. We're not really seeing any inflation concerns as far as the economic reports and the technical charts that we're looking at. But that could always change. We can only go with what we see right now. Anybody can predict anything and come up with whatever forecast they want. We look at real factual data, as factual as we can get here. And you can't get much more factual than just looking at a price chart. I know some of these economic reports, they're manipulated and they can be changed. In fact, we saw that with PPI this week, where the previous numbers were actually revised up. The market could have freaked out over that, but didn't. So that just kind of shows you that the market's focusing more on the positive right now. And there's the debate going back and forth. Are we going to go into a recession? Are we not? Now, the market is starting to shift back. And I update this on some of the other weekly videos that you'll probably want to check out, where we look at the struggle between stocks and bonds. And we were going into that direction where it looked like we might be heading, at least from a market perspective, into a recession. But now we're starting to shift back. And the employment data that we're getting for right now is holding up quite well. So that's not really signaling a real downturn in the economy. People aren't feeling really good because they're confused. And there's a lot of change that's happening right now. And whether we might talk about wanting change, but when it comes down to change actually happening, that gets us out of our comfort zone. Even if we don't really like the situation we're in, at least we know it and we kind of understand it, and it's what we're used to. You get out in a new area where things are changing a little bit, even though you might want it, it still can make you feel uncomfortable. And so we're seeing sentiment coming down. We had that report on Friday. All right, and then the condition of our trend is still negative here on the weekly chart, but showing some improvement, and I'll show you that chart there. So we had some nice gains here. The Dow is actually back to being positive year to date. We went up above, a little bit above the 200-day moving average, and it had been negative. The S&P went negative earlier in the week, but we were up 3.4% with the Dow, 7.2%. That is a big move for the NASDAQ. And then 5.3% for the S&P, and even the small caps were up 4.5%. So just some bullet points to go through. The S&P and Dow turned positive again for the year during this past week that we just ended. The market was enthused by this trade deal that came out a week ago, and we really gapped higher. The futures were really strong, and we just kept getting stronger. And by the time we opened on Monday, there was like a 3.5% gap to the upside. Freaked out all the short sellers, all the perma bears. They're like, oh yeah, it's not going to last. Well, it pretty much lasted throughout the week. We'll have to see. we're getting overextended to the upside right now. And if we do see any kind of a pullback, we'll just fall back and regroup and evaluate it and see, are we just kind of working off some of this froth right now, or are we actually switching back and looking more negative? But the US and China agreed to a 90-day reduction in tariffs. This was a week ago. This is old news now, which went into effect this past Wednesday. The US dropped the tariffs from 145% to 30, and China dropped their tariffs from 125% to 10%. Now, the only drawback is this only lasts for 90 days. So, but at least this buys a little bit more time. It's calmed down. Not only the US markets, but the global markets are a little bit more at ease right now. And so now they have 90 days to try to work something else out that's a little bit more permanent. Then the market focused on this being a positive thing, and it ended up being an everything rally. Growth did well, but value did well too. But the only thing that really went down was gold. And the dollar went up, all different stocks went up. Moves were helped by short covering. This is people that they go in and they short the market. So they sell to get in, hoping to buy it back at a lower price. Well, they got stuck. And we get the phrase, don't sell yourself short from this. And it's basically you talk yourself down. And well, when they're losing money, they have to come in and buy, and that can help boost prices up higher. And that's called a short cover rally or a short squeeze. And then the fear of missing out. You got a lot of people that are like, we can go back and look at the chart now and say, yeah, I should have bought right around April 7th. That's when we hit the low. But think about what was going on at that time. We didn't know if we were still going to break even lower. We didn't know that this news was going to turn out positive. It ended up working out that way, and the market was able to really bounce up off of some good support and is seeing some real improvement. And now you've got folks that don't really pay attention to the market that much. They might just hear about it or know a little bit about it or hear it from a friend, and they're like, oh my gosh, I need to get in. I need to get in. That's when it gets a little bit of a frenzy, and we were looking tired in the market a week ago. Well, we were able to hold on to those gains and even go up this past week in a really big way. And then you've got people over the weekend who are going to watch videos like this one and say, oh, I'm going to buy on Monday. Well, be careful about that, because when a lot of people get sucked into something and everything's going in one direction, it usually has a way of stopping and going in the other direction. If the real money that powers the market, if they're done buying, who's really left to buy? Okay, also, there was the emerging view that stocks are due for consolidation. That's the nice way of saying a pullback. Since we really bounced up, we're up over 23% from the April 7th lows. 23.23%, I think, if I have that right. That's a big move. If you bought right at the bottom there, man, you're just really sitting pretty. You could take the rest of the year off. You've got a 23% gain for the whole year. That's double what the average is for the S&P. But it didn't materialize. The decline, this consolidation or pullback, as I call it, there was a little bit that went on, and we went sideways for a while, but we held on to the gains. And so this just shows that right now, anyway, the market appears to be strong. But at some point, it just only stands to reason, shorter term traders and folks that did get in closer to the bottom, they're going to want to come in and take some profits at some point, and they're going to have to do some selling to do that. So the S&P was down 17.8% for the year. Now I measure it based on 21% from the all-time high, and it was even a little bit more than that if you measure that on an intraday basis. And we hit the low at 48.35. With Friday's close, we're up, I had it 23.23% here, higher. And it's higher than its April low, and it's only 3.2% below the all-time high. Now, that 3% can be really hard to get, but we're getting close. We're trying to get back up to the 6,000 level with the S&P. We're in the 5,900 range now. So there was a lot of attention around mega caps, large cap stocks. These are the stocks that really drive the indexes, and they did well. NVIDIA was up 16%. They'd been really worried about what's going to happen with all these tariffs and different trade deals and regulations and things that were limiting what they could do. Apple, they also have a big impact with China. It was up 6.4% for the week. But then we had UnitedHealthcare. They've got some problems there. They were down 23.3%. Okay. And it's in the Dow. And even though the Dow was able to get back above its 200-day moving average, that's in spite of Healthcare dropping 23.3%. My goodness. And then there's news that the CEO is going to be stepping down for personal reasons. Don't know what that means. And that the company, they've suspended their 2025 outlook. Like, this is what we're going to earn. These are our profits. These are our revenues, as it grapples with higher than expected medical costs. Okay. A lot of problems in a really big company. Then the CPI, that was the consumer price index, it lacked any tariff inflation shock. And then we had the number that we got for PPI came in a little bit weaker than expected. It was the previous month's numbers that were revised up. And that could have caused a real shockwave through the market, but it didn't. Retail sales, kind of flat, doing okay. Industrial production, jobless claims. I'm really keeping an eye on that to see what's going to happen as far as the recession. And then we had regional reports, Philadelphia Fed, Empire State, that's New York, the NAHB Housing Market Index. They were kind of mixed, but these aren't really influential. We just like to look at them to see how are they doing as far as the economy as a whole. We did go up with the 10-year yield. It did go above 4.5%, but by the time we closed on Friday, we were down at 4.4%, which is up for the week. Now, one thing that I will mention that happened after the close on Friday, Moody's did come out and downgraded U.S. debt. The market hasn't had a chance to react to that yet. So I'm going to be watching the futures Sunday evening. We'll see if they gap lower. Now, this has happened before, and a lot of people predict the end of the world as we know it, only to have stocks kind of go down a little bit and then end up going back up. So there's going to be a lot of doom and gloomers out there who are just going to use this as an opportunity to spread their doom and gloom together. Now, this is a chart that I show every week, and we're still, it appears that we're in this dark blue area here, this line, where we still see inflation for the most part going down. Now, the reason why I show this chart is because looking out into the future, things can change. We don't know. And this is just comparing 1966 through 1982 to what's been happening over the last couple of years. And it was looking pretty good back in the mid 70s as well before we took off and had stagflation. We don't know if it's going to play out that way, but right now I've been showing this chart now for a couple of years, and we are still in the lower part of this inflation area of the chart. And we are above the 4.02% with the 10-year yield, and when we ended up closing at 4.44%. When we get above the 4.02%, that's when it starts to bite into corporate profits. Now, profits are still good, they're still positive, but they're not as robust as they were before. And some of that can be blamed on interest rates going up because companies have to pay more to borrow money, and that bites into their bottom line. This has not been updated. It won't be updated until we get the next employment report. Then we look here, and I showed this chart maybe a month or two ago. It was probably back in February when we set the all-time high. But this just says, looking historically, stocks rarely peak in February. They have twice, and this goes back to 1950. And so this kind of maybe means that we have a shot at stocks going up from here and setting a new all-time high. We don't know that for sure, but December ends up being the most positive month of them all. And the main difference between short-lived and prolonged equity drawdowns is whether there's a recession. Now, we're not in a recession right now. Some people, they say we are already in it. Well, where's your proof? Other than just some opinion that you have. The employment numbers are looking good. Interest rates are fairly under control. We're seeing earnings still positive. The employment is still looking pretty good. And if you hear some noise in the background, there's some construction going on that I can't control. But basically, if we see the problems that we've been having lately, it depends. If we go into a recession, then we look more negative. If we don't go into a recession, then we are more positive. And that's when we have a close to or larger than 20% drawdown. And we were there. We were almost there 20% with the S&P when we fell in early April. And so far, we're not in a recession. So we're at least the path less traveled, or the Y in the road, however you want to see that. We're going on the dark blue area for right now. We'll see if that ends up changing or not. And then this is something that's old news. If you've been watching any of the videos that I do, this is a Bloomberg chart just showing that we were able to get back above the 200-day moving average. Okay, then this is a composite. I'm not sure what makes this up. It's probably proprietary, but we're getting up in here into the pink area, and this is just showing that we're overbought. And I have a lot of charts that also confirm that, but we've been up here now for a while. If you watched the video a week ago, I was talking about the market looking tired and we're overbought then. We're even more overbought right now. So we can stay up here when the market is looking pretty positive. But at some point, expect this to drop down if prices start to fall. And I'm not going to go through all this. This is just the Goldman Sachs forecast for the S&P cash spending. Just what are they going to spend their money on here? If you're interested in that, feel free to pause it and just kind of gaze at the numbers in this chart. And we did get housing permits. They're not really going up all that much. We keep an eye on this because that tends to be a leading indicator, because you have to get a permit before you can build something. And they've actually been coming down just a little bit here. And we usually see this falling before we end up heading into one of these gray areas, which is a recession. Now, we're not really falling all that severely right now, but we do want to keep an eye on this. And then index return of cyclicals, those cycle with the economy. When the economy is better, cyclicals do better. Defensive, they hold up even when the economy is going down the toilet. And that's toilet paper and toothpaste, things that you have to have. Well, we've really been seeing the cyclicals coming down. Well, now they're starting to go back up. So we're seeing some improvement here in this whole picture. And earnings sentiment starting to turn back up after it had been declining. And this is not only for the U.S., which is the dark blue line. This also goes across the entire globe. Then FactSet, we're pretty much done with earnings season. Now, there's always earnings that come out, but most of the companies report right around the same time. And basically, this kind of feeds into logic. If a company comes out with a positive surprise for their earnings, they tend to go up. And if it's a negative surprise, they tend to go down. And both of these charts pretty much bear that out. And that's why they tend to lowball it, hoping that when they come out with their report, they'll surprise the market and get a nice little pop. Then we're seeing an awful lot of companies that are mentioning the word tariffs. See this really spiking up here? When they make their earnings calls. That's all the buzz these days. And you've got people that don't even know what tariffs are that are suddenly throwing that word around. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, so here is the intraday chart going back to Monday. I should have made it a little bit longer. We saw a big gap up. We were below this red dashed line. This was 57, well, it still is, 5,700. We were below that a week ago, Friday. Well, then we gapped up, and then what we've been seeing kind of right after the open, we're not seeing an awful lot of gyration at the open. And we've just kind of seen some sideways action. And then later in the day, we see the smart money coming in and doing some buying. And that we held on to those gains on Monday. Now, we did see a nice little bump up here on Tuesday, right after the open. But then we were able to hold on to the gains. And we were pretty much flat on Wednesday. No real gyration at the open. And then we actually gapped lower on Thursday, but then we're able to come back and close pretty much at the high. And then we had a little bit of a higher open on Friday, and then we closed at the high. So there's really no pullback, or what they call it, consolidation, that really took place in here during the week that really amounted to very much. So all of the different indexes ended up being up, and these are just the 5 trading days that we went through. The NASDAQ was up the most, followed by the NASDAQ 100. These are growth areas, and we like that they're leading. And the S&P was in third place. And Even the small caps and the Dow ended up being positive as well. This is year to date. We still have small caps, mid caps are negative. The NASDAQ just down about a 0.5% right now, where you have the Dow, the S&P, the NASDAQ 100, and the NYSE, which is more of a broad market measure. That really held up better when we were going down, and it's doing a little bit better as we're going back up. So they're positive year to date. Then looking at the sectors, we had an up week. This is what we like to see. Tech leading, discretionary near the top, second place. Communication, another growth area near the top. Industrials, more cyclical, meaning the economy is looking okay. Then we like it when staples, real estate, healthcare, and even utilities are near the bottom. So we like that. This means the market, at least for right now, is turning back and becoming more offensive rather than defensive. Then this is that same chart, but then it's sorted a little different way based on the scooter score. The higher the score, the better looking that particular sector. We have industrials looking the best, tech, communication, and then discretionary. We like that they're doing well. And we have materials, energy, and healthcare. They're the ones that are lagging. And staples are not doing as well. That's more of a defensive area also. So looking at the sectors just for the 5 trading days, we had tech. Now utilities were up. You could consider utilities a growth area because of all the electricity we're going to need for AI and crypto mining and all the other things and EVs and everything else. But then communication was up and discretionary. We like that these were positive, where healthcare just is getting hammered right now. And a lot of that has to do with UnitedHealthcare. Then year to date, healthcare is the worst performing sector right now, followed by discretionary. Even though it was up this week, it hasn't been doing very well in 2025. It needs to do a lot of damage repair there. Where we have industrials, more cyclical, utilities, either defensive or you could say a growth area. Financials, that seems to be doing well. Communication, and then staples had been doing better earlier on. Now they're pulling back just a little bit there. Then this is recently added to the videos that I do. This is a weekly chart called a market carpet, and it takes all 11 sectors of the S&P. Like right here's tech, and you have financials and discretionary, healthcare, communication, industrials, energy, real estate, materials, and staples. And you can see the bigger the box, the more impact that stock has. And I show it in the daily video just for that particular day. This is for the whole week, and you see an awful lot of green here. When you get into healthcare, though, you see some really, really dark red here for UnitedHealthcare. And we're seeing utilities, seeing a little bit of weakness, but this just gives you a visual representation. When you have stocks in discretionary like Amazon and Tesla, Apple, Nvidia, and Microsoft, they all are up on the week, plus Google and Meta, you've had a pretty good week when there's really big plus signs and percentage gains with those particular stocks. Then this is another way of looking at this, a relative rotation graph. The upper right corner, that's the most positive thing. And this goes over the last year, and you can see the areas that had been stronger are starting to turn down now. Things like staples, they're still positive, but they're starting to go down. Utilities are still pretty strong. Real estate's starting to turn around. Healthcare is starting to turn around. Industrials are coming on a little bit. Energy's turning around. Materials are coming on. And we're even seeing some improvement here with XLK, that's tech, and XLY, that's discretionary. These are starting to turn up. And if you don't like how it's represented there, this just gives you more like a spreadsheet here. The areas that are still positive are in green, then the yellow areas are more neutral, and then the red areas are negative. Then we look at the different indexes, and we haven't seen the S&P move all that much. It's been right around the middle because it's balanced. It has growth and value in the index, where the utilities are still the strongest over the last year. And then the mid caps are coming on a little bit here. We're turning back up with the NASDAQ 100. The OEX, that's the S&P 100, which are the biggest stocks that make up the S&P 500. It'd be nice if those would turn back up. And we're seeing a little bit of an improvement here with the small caps, but the transports, even though they were up on the week, they're still one of the worst performing areas and have been for quite a while. Again, more positive areas, the yellow's more neutral, red, and then those areas that are showing some improvement like the mid caps. Sentiment. Now, just a month or so ago, we could not get above 25 with our sentiment gauge. Here it's called the Fear and Greed Index. Well, we've been going up and we got beyond 50. And so we're actually coming up into 71 now. Now, this is the point where we follow it as it's going up. As this is going up, we're positive on sentiment as well. But when we start to get close to the 75 area, this is when we consider saying, okay, if everybody's getting real happy, now it's time for us to be a little bit more pessimistic on things. We don't turn negative right away. We're just open to that idea happening. This is a historical chart where we spent a lot of March and into April below 25. And then we go with this as it's going up. But then as we get closer to 75, that's when we start saying, okay, we're getting a little toppy here as far as sentiment. Active asset managers, no real change here. They're pretty much neutral. And they came in with a score of 70.56. The VIX did drop down below 20. That's more positive. That we're seeing fear starting to come out of the market. This ratio is going back down, which is positive. That means the tech sector is outperforming cash. When this goes up, that means it would be better just to keep the cash in your pocket than to buy some tech stocks. Well, not so much now. They've been really improving. And then the Ridex bear bull ratio, they've been getting jacked all over the place. They really were negative. Now they're starting to turn a little bit more positive. But when they're really positive, we see much lower readings than what we're seeing now. Now for 10 weeks, we were extreme negative with individual investors. They finally are showing some improvement, but they're still negative overall. This reading is still coming in below zero. The Ulcer Index, this is another fear gauge. On the weekly chart, it's above the moving average. It's dropped below the moving average on the daily chart. And this is improving too. The spread between risky and not as risky bonds, when this is going down, that's more positive. Now, the next chart is just an inverted version of what I just said. When this is going up, that means the risk is coming out or perceived to be coming out. And this is what I use as kind of a sentiment gauge for the bond market. When this is going up, the bond market's feeling better about things. When this is going down, they're feeling worse. And then we're starting to come down when we look at the VIX and then the 3-month average of the VIX and do a ratio. As we were really going down, this ratio was going up. Now it's starting to come back down, which is more positive. And we never did really turn up with our 253-day moving average of the equity put call ratio. Usually when we really start heading lower, this will turn and go up. It just kind of slowed going down. And now that we're going back up, it's resumed going down again. Then we're looking okay here with our weekly chart of the economy. We're still below the black line with the national financial conditions. And now we're coming in with the Atlanta Fed with another GDP forecast here, where they're coming in a little bit over 2% with the latest reading. With the different forecasts, we have 3% to the upside and minus 1% to the downside. And just showing how we, for right now, based on what we've already received as far as GDP for the first quarter, we are negative. Now we're going to have to be negative for 2 quarters to be considered in a recession. And the fact that we're going back to looking positive, that could help things. We'll see how things are going forward. But the New York Fed, they're a little bit more positive, coming in at 2.35%. This hasn't been updated either. It'll get updated when the next employment report comes out. I haven't updated this because we're still below the black line, looking at the probabilities of going into a recession. This only gets updated every quarter, and the last time we had this chart updated, it's still going down. Inflation, we did get CPI that came out this week, and so we're seeing some adjustments going on here, but nothing really crazy at this point. Now, there's a 91.7% chance that the Fed's going to keep rates right where they are at 4.25 to 4.5 when they meet on June 18th. And that's really becoming more likely here, and the market's getting more locked into that. We see that the dark blue, that's the latest rating. Then we have a day ago, a week ago, and then a month ago. And the market's getting more and more convinced of that happening and less convinced that they're going to cut rates. But you have to think, why would they cut rates? Is it to stimulate the economy because it's humming along pretty good and could even handle going a little bit faster? That's what was supposed to be the rate cuts for last fall. This would be, they would be cutting rates because the economy is having some trouble and they need to stimulate it because it's actually going down. Well, now it seems like the market's a little bit more convinced that the economy's in okay shape right now. Then we look out at the July 30th meeting, 33% chance that they'll leave rates the same, 34% chance that they'll cut rates 25 basis points. But this will change a whole lot. And we see this kind of jockeying around, but you're seeing a lot more people kind of locking into this idea that rates are going to stay where they're at. The Fed balance sheet continues to decline, but the year over year continues to go up. When we look at the Fed balance sheet, we just watch this for informational purposes. And then we watch the overnight reverse repurchase agreements here. We're seeing anything really weird happening. And right now, nothing really crazy is happening with the banks. And that's a good thing. All right, so we are setting an all-time high with the advanced decline line based on price and volume. We bounced up off of the moving average here. And that's about when we hit a low and started to go back up. We're also hitting all-time highs on the daily side. So we're seeing confirmation there. And we're seeing more of an expansion of the new highs. And so we're going up with our 4-week moving average, and our 10-week moving average is going up. The advanced decline ratio getting a little extreme with the 19-day on the daily charts. This is a 19-week here, but we're still above zero and advancing. Our trend is still negative. The red line is above the green line. Even though the red line's coming down and the green line's going up, we are starting to roll over with the ADX. Now, if it drops below its moving average, that means it would be a weakening trend. Until that happens, we consider this to be a strengthening trend. That's still negative, even though it's showing some real signs of improvement. And we're still negative with the Arun indicator, or the oscillator is still down below zero. Mass index is not generating a signal. Here's the daily chart where we finally were able to break above the 200-day moving average with the S&P. And then we kind of stalled out here at this pivot point. This is how important these pivot points are. We couldn't seem to get above that. Well, finally, we were able to break above that and close above it. So that's looking more positive. And after falling below the 50-week moving average here, we've been able to come back above it with the S&P. We're still in a downtrend, though, both on the daily side and here on the weekly side. It takes a while for the moving averages to adjust and cross back over each other, but we are above both moving averages now. We're well above the midpoint here, going back to 2009. That's positive. This is about where we hit some support. And we're showing even more improvement here. We're above the pivot point, and we keep advancing as we go up off of this. Kind of the line in the sand is when we're above the pivot point, that's positive. When we're below the pivot point, that's negative. We had dropped down below it. We held on to support for a while, came down, but then came back up. And then we've been able to get back above this pivot point. So longer term, that is much more positive. We look at the accumulation distribution, or we're positive here. We're above the moving average, and the moving average is going up. Then I also put a boom indicator on here as well. Then it actually is working out to serve a different purpose than why I put the chart on here, or the indicator on here. But this is positive, and we're above the moving average. We're a little bit concerned that we're getting up to this red line. That might mean that we're getting a little far away from the moving average. Then our second smart money indicator, the Chaikin money flow, the histogram is going up and the red line's going up. That's positive. And we're going up here with the weekly chart of the Chaikin oscillator. This is our third smart money indicator. Now, on the daily side, we're getting pretty close to this red line. That's another overbought concern that we're watching. We're just coming up to the green line here. It still has more room to go up, but there have been times when it's come up to this green line, and then that was it for a little while. We're still negative, though, with the vortex, even though the red line's coming down and the green line's going up. We're positive on the daily side. And we're starting to get extreme with the McClellan oscillator, where we are also extreme on the daily side. And we're above zero and going up with the summation index based on price and volume. We're seeing pretty much that same thing. We're getting close to this red line on the daily side. And we're also getting closer on the weekly side, just suggesting that we might be getting more overbought in the intermediate term. And this is actually negative on the daily charts. We're positive here with the bullish percent index, but you see how it's coming down? Now, the reason why this is a big deal is I put a moving average here on the daily side, and we're dropping below that moving average, which is turning this indicator negative. Another thing is, when we were coming up out of this, it was the bullish percent index that was showing some strength as we were trying to come back up here. We were just getting jacked around all over the place with price, up, down, all over the place, big up days, then big down days. It was just insanity. Well, you can see the bullish percent index was really showing some strength all along the way here. And we were seeing that pretty much the same thing on the daily side as well. Well, now it's starting to show a little bit of weakness. Now, it's had a really good run and maybe it's due for a rest. We'll be waiting to see if we do start pulling back more. Is that going to turn into more of a decline or just a wearing off and slowing down a little bit? We're positive with the swollen trading oscillator based on price and volume. They continue to go up above zero. Momentum is trying to improve. We're trying to turn back up here with the PMO, but we're still negative. We're above zero based on price and volume. We're starting to get extreme with the PMOs that are rising or above this green line. The buy signals are also extreme, but we are showing an improvement with the PMOs that are above zero. We're above the midpoint here with the Bollinger Bands, percent B indicator. I use this indicator to determine if we close above or below the upper or lower Bollinger Band. We're not there. So then we say, all right, are we above or below the midpoint? Well, we're above it now. So that's looking more positive. We're trying to turn up here with our shorter term oscillators, even the intermediate term. We're trying to turn back up. We're still going lower with our longer term oscillators, but we have turned positive now with the Copic curve. This is another momentum oscillator that I don't have on the previous chart. We're positive with the force index, and we're back above 50 with the money flow. Now, 1 week over another week, we had over 5% gain in 1 week. Yeah, we kind of overdid it a little bit here. And even last week was a good week, but not all that great, but we held up fairly well. But this was more of an explosive week, mainly because of the trade news that came out. And we're also improving here with our 50-week rate of change. We came almost down to the center line here, and now we're starting to go back up. We're back above 50 with the relative strength index. We're starting to get extreme, showing good momentum with the Stochk RSI and the Williams percent R. We're back above 50 with the ultimate oscillator. We're still barely above the red line here with the special K. We're negative on the daily side, but it's starting to turn up a little bit. And then this is the 50% retracement. We just nailed that puppy right on. This goes from the 2022 low to the 2025 high. We retraced 50% of that, and it was right at this point when the smart money said, okay, that's enough. We're going to come in and start buying, and they took us up off of that. All right, so looking at the trends, we're looking more positive here with the Heiken Ashi. With the Kagi chart, we're positive. Renko chart is positive. The 3-line break chart is now turned over positive. We went up enough to draw in some new X's here. So that's more positive. A long tail up that was generated on May 12th. It's actually a negative pattern that's being seen here, but we are going up nonetheless. And we are improving, but still negative with the ease of movement. The longer term momentum, after coming almost down to zero, is now starting to bounce a little bit. We're turning back positive. The intermediate term momentum, we are positive and possibly extreme positive here with the short term momentum. We are positive with the Elder's Impulse system for the S&P, and for the second week, we are positive with the Parabolic SAR. The dots are underneath. We're also positive on the daily side. And we're looking at the different short, intermediate, and long term. We're positive across the board with all the stock indexes. We still have the small caps negative in the intermediate and long term. We recaptured the intermediate with the mid caps, but we're still negative in the long term. And then bonds are negative across the board on all time frames. We have commodities in the dollar up in the short term, but down in intermediate and longer term. Then just looking at the indexes without anything on them, you can see how the S&P's been bouncing back up. The mid caps have really been bouncing up too, but underperforming. The small caps, they went down a little deeper here. They're improving, but they have farther to go to show more improvement. The Dow is in a downtrend, but now above both of its moving averages. And you're going to see that with a lot of the charts here. NASDAQ, downtrend, above moving averages. NASDAQ 100, downtrend, above the moving averages. Mid caps, downtrend, finally getting above their moving averages here. Small caps, still below the 50 week, which is supposed to be like a 250 period day moving average. But this is improving, but still looking more negative. This is a daily chart of the Wilshire, a broad market measure. We were able to get back above both moving averages. The NYSE just barely hung on to keeping an uptrend, and now we're above both the moving averages. All stocks really showing an improvement here. The FANG index also back above the moving averages. ARC, it even got in there. It was up 13.67% on the week, but still has a ways to go to get back to its higher end of its range. And then the banks showing some improvement here, longer term. We're above 50 with the RSI. We're negative, but turning up with the momentum. And then if you go back to 2021, every May has been positive. Now you go back further than that, and that's when you start to see down Mays and so forth. There's this saying in the market, sell in May and go away. Well, the last 5 years, that would have been the exact wrong thing to do. But I don't know. We're only halfway through May, and there's still more to come. But we've been up 100% of the times going back to 2021 with a return now of 2.5% for May. Then this is looking at the different indexes, traditional Dow theory. The Dow is showing some improvement. The transports, they're improving, but they've got a long ways to go to get back some resistance levels, or the utilities has pretty much been going sideways. Then we look at some other markets here. The CRB index, these are commodities. It's still in an uptrend, but pulling back. Oil still continues to be down in the lower 60s. The dollar, it got back above 100. It's still in a longer term downtrend. Copper, even though it pulled back on the week, it was down over 1%. It's still in an uptrend. And that is one of the barometers that we use to look at the economy. We're also still in an uptrend on the daily side as well. Gold pulling back after apparently hitting the moon and then bouncing back from it a little bit. Silver still in an uptrend, but not performing quite as well. We look at the price of bonds, the total bond ETF, this is still in an uptrend. The stock to bond ratio, now we're only halfway through May, and this is a monthly chart, so it doesn't finish drawing until the end of the month. But for right now, it's looking much improved. This is a daily chart of yields, how they had been coming down. Now they've been starting to go back up. If they keep going up, that's going to be more of a concern. A weekly chart here of international rates, how they've been going back up as well. Then we look at the intermarket analysis chart. And I actually do an intermarket analysis video, but this just gives you a look at this based on one chart. Gold, even though it's been coming down, it was up over 30%. Now it's up just a measly 22.25%. Yeah, all right. Now, stocks have actually come into second place year to date, where we see commodities going down, and then the price of bonds are about even with each other, then the dollar, and then oil has been the worst performing asset so far in 2025. The NASDAQ 100 growth to the S&P, growth and value. We like it when this ratio is going up, even though this ratio is in a downtrend. The S&P 100 still hanging on to a downtrend or an uptrend compared to the S&P 500. We like it when the bigger stocks outperform the rest of the S&P. They tend to help the S&P go up. Growth really improving when compared to value. Gold coming down compared to stocks because it was really going up as the S&P was going down. Now that maybe insanity isn't breaking out permanently, we see gold coming down and stocks going up. So this ratio has been going down. And a little bit of recovery here when we look at the gold to dollar ratio. It's been coming down after just skyrocketing up. And then bonds were starting to outperform stocks. Now we see them pulling back. Low volatility, toilet paper, toothpaste. Really starting to outperform when they were afraid that the economy was falling off a cliff. Now it's been coming back down. Discretionary, improving greatly when compared to staples. Energy had been breaking out compared to tech. Now it's starting to pull back. And then small caps, just even though they've had a good week, they've really been underperforming, and tech had an even better week. So this ratio continues to go down. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then some long-term looks here. This is the NYSE breadth thrust, pretty much at the midpoint right now. And we're coming down a little bit here. We're seeing a little bit of weakness with the swag NYSE breadth thrust. Now the signal is already on the books. We hit that in April, and then we zoomed up here April 24th. We got there within the window of time. That's done. That's goes forward. What I'm looking at here is this pullback. We're seeing this actually going down as the S&P has been going up. Now, this is based on the NYSE. So this is a little bit of a negative divergence that I'm picking up on right now. We're still above the long-term trend line going back to the 1987 crash for the S&P. Here's a look at that same chart, still looking good there. This is the Zohorchak, where for pretty much all of 2023 and into 2024, we were at a full-on 10 buy signal. It dropped down to 8. Now it's dropped down to 4. It's picking up something. Now it's still positive. It will be positive unless we drop below 0, and it has 4 notches to go before we get there. But we just want to keep an eye on this. At some point, if stocks continue to go up, we want to see this chart go back up as well. That would be more of a confirmation. We're improving, but still negative with the 50-period moving average of the new highs, new lows for the S&P. Also improving in the NYSE, coming back up, but still below 0. And we still have a ways to go to get back up to the trend line with the weekly chart of the NASDAQ 100. This ratio, NASDAQ 100 growth to Dow value, and even though there's some growth stocks in there, we're still above this red line here. That's a healthy sign. And the QQQs, which is the NASDAQ 100 of small caps, we're just busting out, breaking out, almost making new highs with this ratio. Not seeing a breakdown like we saw during the dot-com boom and then ultimate bust. We're doing okay, going up a little bit here with the 3-month yield. What I'm watching for is, are we seeing it really falling apart like right before we went into the great financial crisis? Nope, it's hanging in there for right now. We're still going down with the cumulative new highs, new lows for the NASDAQ. If we continue to go up, it's trying to turn up a little bit right now, but we need to see this turn up and stay going up to be more positive. Then seasonally, now the last 5 years for May have been great, perfect. But when you go back to 1964, we're up 60% of the time with an average return of 0.2%. And we usually start the worst 6 months of the year in May through October, where we're up 1.7% of the time, and we're only up 64.9% of the time. 1.7% return. That's what I should have said if I didn't. And then we're up 12 out of 18 times in a post-election year, going back to 1950 for the S&P, where we're down 6 out of 18 times. Then May has historically been a strong month in a post-election year, no matter how you look at it. You can go back to 1950, go back to the last 20 years, 10 years, post-election year. They're all positive when you look at it this way. And then I need to change this because we're actually starting the second half of May. The first half tends to be pretty bad. Tell that to 2025. But the second half tends to perform better. We'll see if we see something like that continue or a flip-flop this year. And then post-election years tend to bottom early in April and then rally. This is kind of the general format that we've been following so far in 2025. And then this looks at where we've been as far as 2025 is concerned, the gold line. And then what NDR comes up with, it's a 4-year cycle for 2025, where typically it looks a little bit better, at least going into about the latter part of the summer. Then, not a real surprise here. We see volume really dropping off with the NYSE over July and August. We also see volume dropping off on the NASDAQ. That just kind of goes without saying here, but this is just chart proof here. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.